So why is this a great time to invest in real estate? The money's tightening, inflation's going up, prices on homes, they're sitting on the market longer. Prices are actually coming down. So we're going to go over today, especially for beginners, why this is a great time to start investing in real estate, mostly in focusing on the money side, because that's what we do, the money, the credit side. Real estate investing is all about, in our world, is leverage. How do you get into as much debt as possible to make as much money as possible? So that's what we're going to go over today, how to make money, what to look for, all those kind of things in inflationary tightening of money. So let's get going.
Money, 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 hard money, Mike. Money for real estate investing. Let's make money, 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 money. Hardmoneymike.com.
Number one, what does it mean when we talk about tightening of the money policy? Everyone hears about the Fed raising rates, inflation hitting, all those things, but what does it really mean practically to real estate investing? What should you look for? What do you need to know? We've gone through this ups and downs and inflation a couple different times now. We've been doing this for over 23 years, so we've seen a couple of market changes. When we're talking about inflation going up, money tightening up, what we see is less money available for everyone, including real estate investors. Instead of what we've had over the last 10 years, where there's plenty of money for everyone, rates keep lowering, LTVs getting higher, money flowing everywhere, what we start seeing is all these funds, all these banks starting to require more money down. They're going to require better credit scores. This is the time to increase your credit score 20 to 40%. This is the opportunity for those who take advantage and get money prepared to really make a lot of wealth. Because what you see is rates are going up, things are tightening up, inventory is actually growing. Sooner or later, what's going to happen is the value, the cost of homes is going to come down and money's high. So if you could buy, and you could buy right at this time, when this flips, when money gets easy again and prices go up, you're going to increase your cash flow multiple times. You're going to increase your net worth multiple times. So that's why in inflationary times, when you're looking at stuff like this, you need to be money prepared. So don't take this as a negative. Take this as a positive. This is the positive. This is what you're looking for to create that generational wealth, is when inflation hits, when money tightens, you are going to be one of the only people out there looking for deals if you get money prepared. So since we're talking about the money side, we're talking about the loans, leverage, buying under market value properties, getting the right leverage. You're using other people's money. That's what real estate investing is all about. Using other people's money, if that's banks, if that's hedge funds, private money, whatever it is, you need to have an array of money available for you in real estate investing. But what happens when this tightens up? What happens to the fix and flip loans? What happens to the loans for your BRRRR or your rental properties? What you're going to see, or what we've already seen, is a few factors. Lower loan to values. What does that mean? Instead of lending $80,000 on a $100,000 purchase, most lenders now are lending 75%. So more money into each property. What else means? Credit scores are going up. We've seen an increase of credit scores of 20 to 40 points. Before, maybe you could have a 760. Maybe now you need a 7 or 720. So they are going up. They are tightening the box. That's when they talk about tightening policy. That means it is the box is getting shorter. Who they're going to lend to, how much they're going to lend. This means more money from you, better credit. You're probably going to even need better, what they call ratios, debt to income, experience, all of those things. Rates are rising and the box is getting smaller. So that means less people are going to be able to qualify for these. So those who do qualify for these kind of loans are going to have a huge advantage. Because remember what we said before in the last segment is sooner or later prices in the homes are going to come down. Because if rates go up, we have a medium we have to reach. We have to hit cash flow. So no one's going to pay more when it's a negative cash flow. So as LTVs go lower, meaning you have to put more money in, rates go higher, meaning cash flow goes down, what you're going to see is the opportunity for people to jump in right now, get the money they need to jump in when home prices are low for when they go back up. Expect less money out there, which means you need to be talking to more lenders. Find out who's still lending, who is not lending. There's less money around for everyone. So those who actually take advantage get themselves in the best position they can with their credit, with their income, maybe bringing in partners, whatever it is going to be. This is the time, this is the place that you're going to create, I keep saying it, the generational wealth. So we're real estate investors, we need money. So where does the money come for investing in real estate in these kind of times, like the inflationary, the tighter money? What you've seen over the last 5 to 6 years or longer is a lot of hedge funds, a lot of money come in from Civic to Finance of America, whoever it may be. They came in and flooded the market with money. And what's happened already is probably about 20 or 30% of those have at least backed off for now, which means they're not lending because they're trying to figure out where the market is going. Lenders don't like when prices start going down because their 80%, their 70% of loan to value they had before now became 90%. Because the prices came down, the loan stayed the same. So the lenders are out there who flooded the market, the hedge funds, even banks. Banks are now being tightened by the Fed. They're being required to have more reserves. So it's going to be a little bit harder to find this money flowing around. But who is still lending? There are still some hedge funds out there. Small banks will still lend to investors, especially the small banks who love investors. You really need to look at some other options. Private money is the same way. It looks like everyone is just taking longer to pay off, which means there's less money. If money's not coming in, money's not going out. The common lenders are still out there. There's just less of them, and you need to look around. The whole object of this video is to let you know that things are changing. You need to be more proactive. It was easy before because lenders kept calling, trying to convince you into buying or getting their loans. What we've seen over the last few months is almost all of the competition in the hard money, go up 20, 30, and 40% on their rates, and most of them have come down their LTVs. The majority are now requiring anywhere between 15 and 20% minimum down, where before it was 10% and sometimes even 100%. You need an array. You need the banks. You need the hedge funds. You need the private lenders, and you really need OPM. You need to spend some time creating a larger pool of available funds. Working with lenders now, it's now time to create a partnership with them, to actually embrace the lenders, find the good ones, work with them. Investors seem to have the control over the lenders and tell them what they want to do, when they want to do it, when they're going to close. That's stopped now. Lenders have less money to put out, so they're going to be pickier. Be one that they pick to do and be a part of this. We're looking at August of 2022. Our prediction is by the first quarter of next year, 2023, that's where really good deals are going to happen. Be prepared with all of your choices in banks, typically small banks, private money lenders, really small private money lenders too, and even finding real OPM. We'll talk about that in another segment coming up here in a second. So understand, if you're just getting into real estate investing in this market, inflation, tightened money is just going to change a little bit. The BRRRR strategy, even fix and flips, all of those things are going to look a little bit different. For BRRRR, it was all about cash flow. It's all about finding undervalued properties. The market for properties hasn't switched quite yet where the deals are there. So you may have to hold off a little bit. We have a great BRRRR strategy coming up in another video. You might want to check that out too. Fix and flips, the same way. What we're finding is on the fix and flips, people are coming out, they're listing them. They were expecting prices to keep going up, people to keep bidding on it. It's not there right now. So if you're looking for investing in this market and going forward, especially on the money side, you're going to look at a couple different options, stuff that's been around before, like subject twos. Subject twos, or when you take over someone's loan on a property, maybe someone bought a house 3 or 4 years ago and they got a 2.5% or 3% interest rate. They can't make the payments right now. They can't sell it because the market has dropped. They maybe bought it at 100%. They need an out. They do not want to go into foreclosure. So this is a great time to actually take over the mortgage, make the payments. So instead of borrowing money from a bank, a private money, all you're really doing is having them give you the loan that's already on the property. That is a great strategy because you're getting better rates than you are in the open market, and you're getting properties typically you don't have to put a lot of money in. So it kind of replaces BRRRR. It's kind of like buying rental properties without money down. Another strategy I've seen worked, I've just talked to a few people who have actually accomplished this, is owner carries. And when people have properties, they take them over, maybe they're free and clear, a family member dies. This is an example of what happened. A family member dies, someone goes to sell a property here in Colorado, they're gonna sell it for $300,000, let's say. The buyer's like, so what are you gonna do with the money? Well, we're gonna take it out, we wanna make some interest, so we're gonna put it in the bank. Okay, so the bank is paying 1 or 2%. She went back to that seller and just said, hey, if you're just gonna take the money out, put it in a bank, why don't you sell me the property and then carry the mortgage or put a mortgage on it and I'll pay you 4 or 5%. So the seller got a better interest rate. It's a secured return. They know the property. It's a great opportunity to start looking for these subject twos or owner carries in this kind of market because everyone's looking for a little bit better rate return or an exit strategy without going into foreclosure or messing up their credit. These are the times we have to switch our strategies a little bit. And like I said, maybe instead of BRRRRs, you're doing subject twos and buying those rental properties with no money down. It's time to look at other strategies. It's time to be understanding exactly where we're going, what's going to happen. The tightening of money, the money available is going to be here for a couple of years. So get used to this, jump in, take advantage of what's there. Stop looking at what is actually negative in this market. There's a lot of positives, especially on the money side, as long as you know how to set it up correct. And if you have any questions, we'd be glad to help you. Just email us, reach out to us, go on social media, post a question, whatever it is. We've been through it. We've seen thousands of transactions, and we'd love to be able to help you. So if you're just beginning in real estate investing and we're working in inflationary, tightening, declining markets, like how do you start? Why do you start? Number one, why do you want to start in a market like this? Because this is where most of the money is created. I remember back in 2010, right after the other crash, I helped 3 or 4 families buy 10 properties. Before it was called BRRRR, but the same kind of method. They bought 10 properties at great values with no money down. I talked to them 11 years later. One of those people now owned 8 of those properties free and clear, only had 2 left to pay. The properties had actually 4x'd. Buying them at $200,000, now they're worth $800,000. And he owns 8 of them free and clear. Cash flow over 4x'd. So back then he got into properties only needing to make at least $500 a month. This is the time where property values go down, interest rates go up. When it flips back, where property values go up and interest rates go down, you could refinance, increase your cash flow because you get a better rate, but also your value's gone up. You have more of an asset, you could take out more money, but you gotta be prepared. To be prepared to take advantage of this, we always tell people, like, if you have the opportunity to get some cash, to put it aside, if it's a HELOC, get that HELOC now on your house so you have it for the future. Maybe start setting up partnerships with people who have some money. There are a ton of people out there who are looking for better rates. There are people 55, 65 and older who have just been hit by inflation just as hard as you, and they would rather have a 5 or 6% return on their money than a 1 or 2% that the banks are offering. Find the people who have money, who would like to get into something that's secured, which is a real estate investing as long as you set it up correctly. Help them have a better life by actually getting a better return. And then you get into more properties. So you can get into the subject twos when they, because sometimes subject twos, you do have to bring money in and you may need that partner. You may need to have other people's money. But real estate investing is all about leverage in other people's money, but it doesn't have to be your money. As you get into this, as you're beginning, set this up correctly, set all the money up, make sure you have the banks, the private money, OPM. You're going to need a mix. You're going to need all of these during this time, but this is the time to jump in. This is the time to start preparing because in the near future, when prices go down, you want to be ready to run and not just, getting ready at that time before all the properties are gone. Our focus here is on being money prepared. And since real estate investing is so heavy based on leverage on the funds that it takes, we want to find the easiest, fastest, and cheapest money. And that really will create the generational wealth we always talk about. So if you're just getting into real estate investing, this is the time, your time in history, to jump in, because things are going to get a little crazy, and when things get crazy, that's when the real money is made. So you need to be, as we say, money prepared. Adapt with the markets, adapt with the changes of where money is coming from. Understand everything you need to do to be successful and have the money to do that. We'll have a lot more videos coming up because things are changing, so please like, subscribe, even share these videos with other people you know. Now, if you're someone who's just starting out or money is not your thing, you need to make it your thing. We have a great course. It's called the 30-Day Fuel Up Challenge, and this will prepare you to find those hard money lenders, the OPM, and get comfortable with all the money talk, how to talk to people, how to find it. If you want to have that up on your competition, if you want to be able to someone to accelerate through, you need to really look at something like this Fuel Up Challenge. There'll be a link below, so please join us on this Fuel Up Challenge. Get ahead, be prepared. Let's all make some money here.